Hey, good afternoon, everyone. Chad Brown with Kinstler Brown. Glad to be with you today, talking a little bit about some of the tax myths that we see in our tax offices. But before we get started, I want to give you a little information regarding Kinstler Brown. We are in the tax and accounting space. Kinstler Brown provides a small business accounting, bookkeeping, and tax advisory. We're also owners of multiple Liberty Tax offices around the Omaha, Council Bluffs metro area. So doing 2,500 or so tax returns each year, we get a significant number of questions that people have, and some of them are great questions. Some are just myths and concerns folks have. So we wanted to talk a little bit about that today. We wanted to engage a little bit amongst ourselves. But if you have any questions, be sure to comment. Some folks that might be interested in hearing week to week regarding some different tax strategies, tax concepts, accounting, bookkeeping, and just some general business topics. Please do share this. We go live every Thursday at 3 p.m. Central Time. Today was a little late due to technical difficulties. However, we're here. So with that being said, I want to introduce Kyle Kinstler and Jordan Kinstler with Kinstler Brown. They're part of the team. And we're just going to have a general conversation amongst ourselves, looking for engagement from you all, asking questions, and we'll try to answer those as we go along. So welcome, guys.
All right. Thanks, Chad.
Hey, thanks for having us.
Yeah.
Jordan, down here.
You've kind of created a list of some of the common questions. We talked to our staff and team, and just some of the questions that we get that sometimes are it surprises us that the questions are being asked because we're in the weeds, right? But and we know this stuff. There's a lot of myths out there. So some of the common ones, and you were going to just throw them out there, and we're going to chat about them.
So first up, in talking to someone we got around here at the office, myth is that students don't pay taxes. College students, they may not pay taxes. What's the link around that one there?
I don't know the context where that comes from. I guess it's just from historically, kids living at home, high school, they may work a part-time job, and their parents have always handled their business for them. Now they're out on their own, and they just think that, they've never paid taxes before. Why would they have to now? But that is not entirely true. In many cases, they may not have to. However, it's not true. And we've had many instances, at least that I've experienced, where folks come in thinking that, and come to find out they should have filed for the last couple of years.
Right. In some circumstances, even you see, you got those really smart kids even who get thousands and thousands of dollars in scholarships, past their tuition, even some student housing and books. If they got money on top of that, they're going to report that as income, and they should be filing taxes on that.
Yeah, correct. Or, a lot of students, especially with the online access to schooling now. I know, Kyle, when you and I were in school, we didn't even know what online was. But Jordan, you just went through school, and that's probably a lot of how your classes were operating. My son's in school, and that's how his are. But you're right. Scholarships in excess of tuition and eligible costs. If you receive more than that, that you're going to be, you could face tax. Now, the issue is, there's the standard deduction, right? So if you don't make more than the standard deduction, you're not going to have any taxable income, and you're not required to file. However, a lot of folks, even though they're not required to file, because their income's not above a certain amount, they could get a refund based on the refundable education credits, because they are paying some, assuming their scholarships didn't exceed their tuition. They may have children, so they have a little bit of earned income, right? So they could qualify for the earned income credit. So they may made a little bit of money, not think they have to file, not paid any taxes in, but they may be missing out on thousands of dollars of potential refund.
Now, didn't they just change that last year where you can have earned income credit if you're under the age of 23?
Yeah.
So traditionally, in prior years gone by, that was never really anything to be considered. So maybe a lot of people, they just didn't even file their taxes, even though they may had some earned income. So let's say if they just had $3,000-4,000 earned income, they probably had some federal taxes taken out, but they could really be leaving some. Actually, if they don't file their taxes due to that lowering the age of their earned income credit, that they could really be leaving a lot of money on the table there too. So
Right.
there's some opportunities there for them.
Right. And yeah, I mean, that's a huge thing. And then the education credit, the Hope credit, that credit is partially refundable, $1,500 non-refundable credit. We won't go into the weeds on that, but $1,000, even if you have no tax, no anything, you can get $1,000 refundable credit on those education costs.
I
Oh,
think
yeah.
that covered that pretty well there. So yeah, myth busted. You might have to pay taxes as a student.
Yeah, just call your local tax place. Call us. We'll go through the scenario and answer the question for you. It won't cost you anything.
Yeah.
How about Social Security? Many people believe that Social Security is non-taxable. What's the take?
You want me to jump in on that one?
I mean, we get that all the time, and it's so hard to explain, what that is. I mean, once you go over a particular dollar amount, once you have a Social Security, then more and more of it does become taxable. I can't. I don't know. You probably want to.
Yeah, it's a real big deal for families, especially husband and wife living together. One goes on Social Security, right? The other one maybe isn't of age yet or hasn't elected to draw Social Security yet, still working. There's a formula that goes into play, but it's based on your other income. So if your other income exceeds a certain amount, a portion of your Social Security could then be taxable. So now only 85% of your Social Security can ever be taxable. So you get 10,000 Social Security, 8,500 could become taxable if you have other income that exceeds a certain amount. Now, what happens a lot is somebody starts drawing, they're not having any federal tax withheld from their Social Security, and then they come and file their taxes and they're expecting it to be non-taxable, but their spouse still makes $50,000, $60,000, $70,000 a year, or maybe they've got some retirement benefits pension of $40,000, $45,000 a year. Now that throws a portion of that Social Security into the taxable column. And if you've got 10,000 of taxable Social Security, no withholdings on it, and you're in the, you have a 20% effective tax rate at the end of the day, which is probably pretty high, but just for simple math, I mean, you could be looking at $1,600 to $2,200 in additional tax.
Right. So,
yeah, so that's a big one. So anybody that starts drawing Social Security, don't sit on it or sleep on it. You need to ask the question, is based on everything else I've got going on. And you may be totally retired. You may not be working at all. And it's not just based on earned income, but you've got pensions, you've got a new, all this other income that's coming in passive. It could throw 85% of your Social Security into the tax column.
Yeah, it seems like you get a lot of customers, they come into the office and they want to know, okay, how much money can I make? Okay, I'm married, she makes, or whatever. It's just, it's not that simple, so
right.
It's, but we seem like we get a lot of that, especially in people when they're coming in on to Social Security.
Mhm.
And my friend told me this, or my friend told me that. So that's why, that becomes a myth, so. Well, my friend got this mortgage amount, it wasn't taxable, so mine shouldn't be. Well, we're never ever comparing apples to apples, when it comes to those things. So
right.
that's what people don't understand. So yeah, Social Security can definitely be taxable. Sorry, but
well, and you made an interesting comment. You get advice from your friend, right? That's
Not a
free.
CPA.
That's free advice until it
Yeah.
costs you because it's wrong.
Right.
Sure.
Right? And that free advice didn't get you anything. It's best just call the office and ask questions.
Right.
Or call your tax advisor and ask the question.
I like it. How about charitable contributions? I got a lot of friends that like to bring their old clothes or some old furniture down to the thrift store, and they pick up that receipt when they're done there, or maybe they'll make a online donation somewhere and get the form from that. Even what's the way around that one?
Well, there isn't exactly a standard line item on the 1040 that gives you a charitable contribution. So there again, something that's never changed, but if you're doing charitable contributions, generally you need to be itemizing your deductions. And if you don't have a lot of, let's say, uh, avenues for which you can itemize, thus, like for instance, you own a home, you have a lot out of pocket, you pay a lot of interest on your home. That's usually the starting point where people can start identifying to itemize their deductions. Then you might be able to squeak in getting those itemized or those charitable contributions in there as well. Another thing that goes in itemized deductions is healthcare. So it's a percentage of it's back to 7.5%. Correct me if I'm
Yeah.
wrong, Chad. It's the amount that's
Yeah.
over 7.5% of your AGI can be considered an itemized deduction on your bottom line. But there again, I mean, it's very difficult. A vast majority of the individuals in the country do not itemize their deductions, especially since the last change in the tax code.
Yeah. And that's a big deal, Kyle. In 2017, they changed and eliminated the personal exemptions and just gave everyone a higher standard deduction, right? So if you're a married couple, your standard deduction is going to be 24,500-ish. Don't quote me on that. It's adjusted every year for inflation, but it's about $24,000. So you can either take your standard deduction or your itemized deduction. And you want whatever's higher because it's going to reduce your income to arrive at taxable income. So what Kyle was saying is spot on. Charitable contributions, you could make $10,000 in charitable contributions, maybe to your church, any organization, 501c3 exempt organization, and think you're going to get a tax deduction for that. But if you've got that 10,000 and maybe you've got 4,000 of mortgage interest, you got a couple thousand in property taxes, both real estate and personal property, and you end up with 20,000 of itemized deductions. Well, your standard's 24. You want to go with the 24 so you don't get anything on the 20 of itemized deductions, except you did a good deed. You're giving back to your community, and that's commendable. Especially now, when you look at the states, it's different. Some states, when the law changed in 17, some states left their threshold as it was, right, with the lower standard deduction threshold. States like Nebraska, for instance, they said if you take the standard deduction on your federal return, you have to take it on your state return. So you wouldn't get the benefit on the state either for those charitable contributions. Now, Iowa's different. They still have a lower threshold when it comes to itemized deductions. So you can get the benefit of those charitable contributions. But again, as we always say, it goes back to that conversation. Now, one of the issues that was created by this, a lot of folks that would give to the church, but maybe they're retired, they'd give to their church or the group they wanted to give to, the organization. They wanted to encourage that, right? But with that higher threshold, you couldn't get that deduction. So one thing that they allow you to do, if you're retired and you get a pension or something, you can, instead of getting 1090R, you get a 1099R for a distribution from your pension plan, but you could have that go right through your retirement plan to a charitable organization. So for instance, let's say you're going to contribute 20,000 and you have no other itemized deductions. Instead of you taking that money out of pocket and giving 20,000 and not getting a deduction for it, and take that retirement money that you're going to get and send 20,000 directly from your retirement account to that organization, that's a non-taxable distribution. So you're saving the tax money on that.
Right.
So that's kind of a workaround
Right.
in that, especially for retired folks. And we've recommended that and saved some clients a lot of money just simply by doing that.
That's a good point. That's a good point.
Sweet. There's a lot of good content there. Well, I think you got the last one, don't you? One more myth to bust here.
What's that? Oh, we're going to talk about the COVID workplace. So, for instance, since COVID and a lot of people are working out of their homes, I think that a lot of times people, because since they're working out of their home, they've got a computer at their home, they got an office space, a desk, a chair. For goodness sakes, they got internet type of thing. This must all be tax deductible, right? And I can expense this on my tax return somewhere. You want to expand on that a little bit for us, Chad?
Yeah, so pre-2017, there was a 2106 deduction. So a W-2 employer that may not have a established office to go to every day could work, and they're working from home, could get deduction for that home office use through a 2106. I'd say unfortunately, the office use of home, unreimbursed employer expenses. They took that away in the 2017 Act, so now only sole proprietors get that deduction, Schedule C for sole proprietors. And that impacted a lot of folks, especially in the trucking industry, right? So they were W-2 employees, but they were getting per diems and all of that. So unfortunately, that took that away, but you're 100% right. If you're a W-2 employee, you don't get the benefit of the home office deduction. Unfortunately, that's part of that act. Yeah, that's a common one.
I can't believe it's been since 2017 already. It didn't seem like
Yeah,
that
it
was
was
that long ago.
2018. 2018 was the first year that was implemented, but passed in 17. And I tell you what, first year or so, it impacted some folks hard because they were getting tremendous deductions for that. Mostly a lot of the trucking industry or travel over the road sales folks. We get a lot of mileage and that sort of thing, but as W-2 employees, not anymore.
Right. So especially like those workers, well, I guess not the home-based business, but those workers that would go from job site to job site. When we used to have the tax offices up in North Dakota, we'd see a lot of oil field workers, and they go from oil rig site to oil rig site all over western North Dakota, and those were, it was very, very impactful once they didn't get that anymore. So it's really something. So, well, thanks for clearing the air on that. So. Excellent. Hey, one thing that just kind of thank you very much for spending the time and kind of going over those things. And as part of Kinsler Brown, we want to be able to provide an added service to what we have here for us. And we do ask you that if you do feel that the content that you get is good information, that please share this information. One thing too is that we haven't come up with a name for this, but we want to do this every Thursday at 3:00. So. If you have any ideas for us, what we'd like to call this thing, you share those with us. We'd like to know that. So, you guys got anything else in closing there? And
I guess the bottom line is, as Chad kept bringing it back to, if you got questions, just pick up the phone. Like, we live in a world of information and easy access to other people, and free advice from your friends might cost you, right?
Yeah, it could.
And we're right here.
Get a second opinion. They may be right 90% of the time, but get a second opinion because that 10% of the time might save you. You know what?
Right.
Mm-hmm.
Right.
All right.
So,
all right. Thanks, guys.
Thanks. Thank you very much.
We'll talk to you next week.
We'll see y'all later.